Cool. All right, we're ready to go. All right, for those of you, welcome back to the channel. Today we're going to give our 2026 projections on where we think real estate is going to go in Southern California. It's been an eventful year. It's been a pretty wild year, pretty up and down, but I think pretty safe. So one thing I wanted to cover is what do we think is going to happen next year? I know people are interested in what's going to happen with rates, why are houses sitting longer, are prices coming down, are prices going up, what's going on with buyer inventory. It sounds like we probably have a new guy coming in at the Fed. How is that going to affect things? So today we're going to unpack as much of that as possible. I'm joined again here with my friend John Torrijos. Thank you for tuning in. So let's dive into this. John, let's give a little backstory on yourself, just a little bit to kind of get yourself familiar with the audience.
So I've been in mortgage lending for about 25 years. Pretty experienced at this. We see a lot of different scenarios, and that's what I'm about, man. We'll just talk some of the financial stuff on my end, and we'll see what we can come up with today.
Yeah, we got a lot. I mean, it has been a wild year. It hasn't really gone the way people have wanted, but I think it's gone in a much more favorable direction than what we're anticipating. So with that, let's jump into these slides I put together here.
Nice.
Okay, so a little recap on the housing market. Sales really did start to. This is one of the lowest sales years we've seen from what I've seen market history. I've been doing this since about 2015. On the actual transaction side, this is by far and away the lowest I've ever seen. But with that, I think things kind of normalized out a little bit. The rumblings were that things were going to come down, either rates or prices. Neither really happened. We've been in this safe little bubble with interest rates for pretty much the whole year, right, John? About six and a
Yeah.
quarter, kind of on average.
Yeah, we started out probably around seven and a quarter at the beginning of the year, and we've come down. I think right now we're probably at the lowest we've been in a few months. You know,
Just for,
so
for reference, about where are we right now?
so I actually checked on that before. Using a conventional loan with about a 740 credit score, 5% down, about 6.125 today with no points. And FHA we're about 5.3, 5.5. So we're doing we're going in the right direction. We're not
Mhm.
totally there yet, but we are going in the right direction.
Okay. I agree. And, with that said, rates kind of finally easing and staying that way instead of, coming down and then popping back up, then coming down, then popping back up and playing this little cat and mouse game like they've been for what, the last 18 months, maybe even
Yep.
24.
It's probably even longer than that. You,
Yeah, and
you know,
that's fair.
it's been wild. I mean, if you remember back in 20, man, I think it was the end of 22, we actually saw 8%.
Mhm.
That was the year where rates shot up about 5% from the beginning of 22. I think it started happening around April or May of 22. By the end of 22, we were in about the 8% range, which was just crazy.
Yeah, and then 22 was that pivotal year, right? Because we started the year
Yep.
at like high twos, low threes.
Yep.
They started climbing. I mean, none of us really predicted it. They were going to go where they went because we were in that nice little insulated government backed bubble for so long. And by bubble, I mean rates were low, like low,
Yep.
low.
Yep.
They shouldn't have been that low that long, but that's another topic for another day. So when we started seeing those fours again, it was like, okay, well, things are going to get better. When we saw them 4.5, things are going to get better. By I want to say it was August, things were like five and a half, five and a quarter,
And climbing fast.
very fast, and it was insane. Then nobody wanted to believe it. I mean, sales really started to stall.
Yep.
During that time, I was telling people like this is the crash right now.
Yeah.
Like this is as close as we're going to get to a crash for a while. And I think in most areas things dipped between June and December. This is 2022 by about 5 to 10% depending on the area.
Oh yeah. It's a trip because timing and perspective, right? I remember that period, 2022, when rates hit 4.5. People were screaming, that's too high, right?
Mhm.
But I bet like right now, everybody would love a 4 or a 4.5. Back then nobody wanted it. Today,
Yeah.
everybody would want it. So it's just perspective and the timing in the market of where we are at two different times.
Yeah, absolutely. I mean, even five and a quarter consistently,
Yeah,
people would love.
yeah, absolutely.
We're obviously a ways away from there as we covered in depth on this channel.
Yeah.
But with that said, rates have really normalized.
Yeah, they've gotten pretty steady. There hasn't been a lot of bouncing around the last few months on rates. It's
Hmm.
one thing, they're staying steady, staying consistent, which is good because we've had those times where rates drop and then boom, something happens and they go up a quarter, a half, three quarters of a percent, almost overnight. We've
Yeah.
seen that a few different times actually. So it's
Yeah, yeah,
nice that they're staying level.
yeah. And looking back, I mean, you can really say rates were very volatile for the last three
Yeah,
years.
yeah,
You
absolutely.
know, but like my point with 2025 is rates have been the most consistent they've been
Yes.
in, I mean, the last probably 7 years.
Yeah, I think for sure they've been pretty consistent. This year we haven't seen a ton of bouncing, but it's been there like these little ups and downs, these dips. But yeah, it has been pretty consistent.
Yeah. So with that, with the consistency and it makes things a little more favorable. There's not as much doom and gloom, not as much news.
Right.
What I've noticed the last, I mean, really 3 months is buyer activity has picked up. Contrary to what you're seeing in the market and what you're hearing about the market, personally, I'm getting more reach outs than I've ever gotten in my career, especially for December.
Right.
People are interested in what's going on. You know, they're ready to go.
Yep.
And I think they're seeing those rates, kind of like they plateaued and they're inching down. Buyer activity, personally, I think is going to pick up going into the first quarter of the year, but we'll get further into that.
Yeah.
Um, the other flip side of that is prices have stayed consistent. The way I put it is we've been like on this little bowling alley in the bumpers for the last year and a half.
Right.
You see prices go up a little bit, then they kind of come down a little bit. And these are 2 to 3% shifts. They're not huge shifts, but they're
And that's
still,
the good thing.
it's consistency.
That, that's the good thing is that we're not seeing like these major increases and major decreases, right?
Hmm.
It's exactly what you said. You might see a home sell for 2% over or I'm sorry, go up a little bit, but you might see in other areas there's a dip of 2 or 3%, which in the big scheme of things, a 2 or 3% drop is not earth shattering by any means. So I think it's good because overall housing is still going up. That's what we're seeing, and that's what's predicted.
Yeah. Yeah, and going back to 20, since we're recapping 2025, we did see, I mean, most of Riverside County, we saw go up about 3 to 4% from January to about July. July hit, things kind of came down about 2 to 3%. So from 2024, we're still up about 1 to 2%.
Right.
It's not huge, but we're pretty insulated here.
And up is better than not being up, right? Whether it's 1% or 2%, as long as it's up, that's what you're shooting for.
It depends on who you're asking. For sellers in the economy, yes. For people that
Yeah.
have been on the sidelines watching since,
For, for
2019, 2020, 2021,
for
that
buyers, yes, it's not so good because especially like you said, for buyers that have been sitting on the sidelines and waiting, we have seen some crazy increases in home prices since 21.
mm,
And yeah, it's tough if you've been sitting and waiting, trying to get into the market.
yeah, and I mean, but the good news is rates have finally normalized out.
Yeah.
Pricing seems like it's pretty much flattened. We'll get into the actual prediction side of where it's going to go, but they haven't skyrocketed the last couple of years. They've gone up,
Right.
they've gone down, but they've stayed, relatively the same. So inventories remain tight. This is still one of the tighter markets. I know depending on where you look, you're going to see that it's a buyer's market. Most areas out here, Southern California, where we cover, we still have about 3 to 4 months inventory.
Right.
Compared to what we were seeing, from like 12 to like 12 to 21, 2012 to 2021, where inventory was about 2 months. Yeah, it seems more like a buyer's market, but I think technically a buyer's market is what, 6 months of inventory?
That's what they say, six plus.
Yeah, and I think we're at a point where it's almost time to redefine that.
Right.
But for the
Yeah.
sake of, for the sake of tradition, we'll say it's still a seller's market, although not a crazy inflated, aggressive, hyper sellers
Right,
market.
right,
Um, so yeah, and one of the things, Inland Empire, if you look at like LA, you see a lot more dips and peaks and valleys. Their pricing out there is a lot more volatile.
right.
Inland Empire, we stay very consistent because we're seen as affordable. So a lot of folks get priced out of the LAs, the Orange counties, the San Diegos.
And, and they
They
come
go
out here.
inland.
Yep, they come out here.
Another thing, typical mortgage payments. Just you're still seeing on your side. I'm not the numbers guy, but about $5,000 a month mortgage.
Uh, a $600,000 home with minimum down like 5%, you're probably going to be in that 5,000 range. Yeah, for sure. It's a challenge, to start out your
Yeah,
first home, even a move up home when you're not used to it at $5,000 a month, you know. But yeah,
yeah,
that's about what we're seeing.
and that's just kind of where things are at. Something I'm seeing on the the listing side is people that got in the last couple years. Things haven't really changed. I think a lot of people were
Right.
banking on rates getting better,
Yep.
so they really stretched themselves thin. So I'm seeing people sell because of that $5,000 price point,
Yep.
monthly. I don't know that that's going to change much in the next couple years, but that's just something I'm having a lot of conversations that are with people that are tapped out. But when they go to rent, they're right about the same price.
And I would say on my end, on the lending side, we've talked to several people that have those $4,000 to $6,000 mortgage payments, and like you said, they've had them for about a year to 2 years, and they're wanting to refinance. And at this moment, there's really not a lot of relief for that just yet. For the people that I've spoken to, without paying
Mm-hmm.
off debt or anything like that. But we are seeing people saying, okay, this is heavy on us, you know.
No, so just to offer some sort of insight or maybe a solution, folks that are priced out of like a full refi for the house, there are options for them, right?
Oh yeah, yeah, there are.
Go ahead and plug yourself on a few.
Like when you're saying the options that are available for people to refi.
Yeah, maybe something instead of like a full refi on the house, like to pay off some credit card debts or maybe help with their student
Oh,
loan debts.
so yeah, one of the things we're seeing in lieu of refinances, we're a lot of HELOCs right now, where people are paying off debt. But a lot of times people let's go back to the people that have 2, 3, and 4% interest rates, right? That's a great rate. Don't get me wrong, but when you look at somebody who has maybe 80 or $100,000 in credit card and other consumer debt, when you say, hey, maybe we need to go to a 6% or 6.25% conventional loan, pay off all this other debt, it can free up about $2,000 to $3,000 a month in additional income. So you may not have the low rate, but you have what you have, which is more important right now, is a little bit more income and more breathing room, a little bit more money saved at the end of the month. And on top of that, we have ways of showing them, hey, let's say you're saving 2,000 a month. You drop that 2,000 on your mortgage payment, and if you're still able to, and boom, you pay that mortgage payment down like super quick. So there's other advantages. It's just about more having an open mind when you're looking at that, because so many people are just fixed on 2, 3, 4%, and can't fathom a 6 or 6.25% right now.
Yeah, and those two, three, fours, we're not going to see it. I, I,
No,
I,
no,
re- I really wish I had that crystal ball to,
right.
but
I, I, I mean,
if you go
honestly,
new builds, you can, but I deal a lot in new builds, and
yeah,
there's caveats to that. It's not just cut and dry. Sometimes it is, but like one of the perks of looking at resale is you have something that's established, you have something that's there. You're
yeah,
not coming in having to do 20 grand. I used to say 10 grand, but now 20 grand in concrete work. Just things are more expensive, but you
definitely.
are getting that rate. But I noticed there's some nuances to it.
Yeah, I think it depends too where you're at, because one new builds are great, and like I was looking at my numbers, I think there was about 800,000 new construction homes in this past year that were sold across the country, and in our area, the rate is great, like because I know you've seen some of those tracks that are doing 3.99, and with the buy down it could be 1.99.
There's one out here.
Oh, but the flip side of that is a lot of these homes have what is it, 150 to maybe $200 HOAs and also 2% tax rates, right?
Mhm.
Where regardless of what the rate is, that's still a lot, adding a lot extra to the mortgage payment.
Yeah, and you hit the nail on the head with that. With that 2% rate, because you have to go back to like 2018, 2019 to really see that on resale homes.
Oh,
Prior
2%?
to that, on resale in Moreno Valley, Riverside, Beaumont, you might see that 2%. Like on a 2005 build.
Right.
It's pretty rare though.
Right, right. Yeah, so if you buy something prior to that, I mean that doesn't have, like, I know an area like where I live in Sunnymead Ranch, the taxes are pretty low in the Sunnymead Ranch area.
Mm.
I mean, but this community is now 30, 35 years old. It's still a nice community, but the tax rate is still fairly low up here.
Yeah, I mean, just to throw it out there, you're 1.12%. You're not going to find that on new builds. You might find little
No,
independent tracks, where you can get that low rate,
right,
but that's like an 8 home track, and you're in the middle of a bunch of 80s, 90s built homes.
right, right.
All right, so we'll get back into this. This is a stat I've seen thrown around a lot. The only 15 to 17% of households can actually afford a home in the area they live. Do you see any truth to that?
I couldn't say the numbers, the percentages, because I've seen that stat thrown around quite a bit as well. When you're looking at an overall picture, so I don't know the actual numbers, but I can say that when we're trying, from the lending side again, when we're talking to somebody and trying to qualify somebody, we're probably we're probably qualifying maybe 3 out of 10 people. And a lot of times it's because of the income. There's not enough income to support the payment.
Hmm.
So that's about a 30%. That's about 30% of people, probably in that range, 30 to 40% of people I talk to can qualify. But again, it's probably isolated and different in other areas.
Yeah, and that would be 34% of people that are actually reaching out too.
Right, right, exactly. Yeah, exactly.
Yeah.
Exactly. So that number could
So
be different. Yeah.
yeah, because a lot of people, if you're not ready, you're not ready. And I
Yeah.
think most people have a very good gauge on we're not there yet. If
Right.
because you got a lot of people still renting for like $2,000, 2,200 a month. Where once that lease expires and the landlord goes back to the market, they're gonna get $3,500.
Yeah, yeah. Like here's the other thing and I think we've covered this before, but when you talk about a $5,000 mortgage payment, you're looking at needing to household income, you're needing about 100 to 130,000, 140,000 of income to for that 5,000, depending on the debt load that they already carry, right? If you
Hmm.
got car payments, school loans, whatever it is. So I mean, it's a significant amount for a lot of people.
Yeah, yeah, and I mean, obviously it's exploded the last 5 years.
Yeah. Yep.
So, all right, now we'll go back in. We'll go into the 2026 side. Mortgage rate forecast. This is more John's arena than mine. I was just pulling stats and finding what figures I could find out there. Average 30-year fixed rate drifting down from about 6.2 in early 2026 to about 5.9 in Q4. So the stats I'm seeing or the projections I'm seeing, it's not a lot of relief on the rate side.
Right.
Is that something you're seeing, or is that something you would agree with or disagree with?
So these numbers here that you're showing, the that's what the talk on the street is, so to speak, right?
Mm-hmm.
Rates will be 5.9. I mean, we're not going to. A lot of the projections are we're not going to see a huge relief in rates. Um, it is going to. I think it is going to open the door because let's say you get to 5.75. I think that it will open the door for more of the sellers, homeowners already that have maybe a 4% rate. They might be a little more inclined because they might go up 2% in rate versus 3 or 4%. If they're buying their next
Mm-hmm.
property, you know what I mean. So Because right now, if you have a 4%, there was a time when rates were at 8.25% a few years ago, like we discussed. So I think it's going to open up the door for some more homes to come onto the market at some point, if we get it somewhere in the fives.
Yeah, and I mean the feeling in the industry for the last 2.5 years now, or I guess two, yeah, probably about 2.5 years, is if we can get the magic number felt like 5.5%.
Right. That was the magic number.
Yeah, and then before that it was four. It was like 4.25, right? And then it was just like,
Yeah.
yeah, that's never going to happen again. So I agree with you. I think if we hit that 5.75, the people that have been waiting, because I know there's a lot of people that bought during those COVID years.
Yeah.
That it's the term is golden handcuffs. They have this house, killer rate,
Yeah.
tons of equity, but they can't stand their house, or they've outgrown it, but they just don't want to give up that rate.
Yeah, and that's a big mind shift for a lot of people is giving up the rate. I mean, I don't blame anybody for not doing that because if you're going to buy a bigger house and your payment's going to be, $2,000 more, that's a big jump, right?
Hmm.
Even if you roll in some of your equity into that new home, but yeah, that is an accurate number of what they're predicting. Somewhere nobody's predicting we're going to be 5.25 or 5.3 or anything like that in the next 12 months. Now, that could always shift if something major in our economy happens, right?
Hmm.
You know what I mean? But that remains to be seen.
So in your experience, let's go a little bit further into that. What major happened? I mean, other than a pandemic, we all saw that. We were all still dealing with that.
Yeah.
But what major in the economy shifts or happens to really bring down rates that drastically?
I mean, really, like something like 9/11, some war causes, like when you go to war, those types of things, the major global events. Yeah, I
Mm.
mean, 9/11 was a United States event, but major events like that can cause rates to come down. So a stock market crash, something like that, could cause rates to get better. Now, nobody's wishing for that, of course, but
No.
those are some major things.
Do you see anything like that on the horizon? I mean, like what it seems like in the news they're flirting with war all the time. That's not what this channel's about, so I don't want to get too far into that.
Yeah,
But with the stock market, we still look like it's kind of like the housing market where there's bumpers. The dips and valleys are a lot more extreme, but it doesn't look like there's anything major on the horizon as far as stock market, right?
it doesn't, but depending who you watch and who you listen to, right?
Hmm.
There's a lot of talk about the stock market is due for a correction, a major correction. I can't speak on that if that's going to happen or not, but that's what they're saying. We've had these dips along the way. Oh my goodness, what was the most recent? We had a recent dip not too long ago, and forgive me, I forget exactly what it was, but the stock market bounced back right after
Hmm.
that. Even take when COVID happened, major dip, and then it just shot up. It shot up. But more recently, though, we had a dip, and it came back even stronger.
Yeah, I want to say it was end of last year, beginning of this year.
I think that's about when it was,
Yeah,
and
it
it
was
came back
aggressive. I don't remember what caused it, but
right.
I know like a lot of stuff dropped and it was like, oh shoot, it's gonna happen, and then
Yeah.
it just popped right back up.
And historically, that's how the stock market works. It goes up, comes down, goes up, and when it comes back, it's typically it's even higher than it was previously.
Yeah,
So
yeah, and I'm not a big crypto guy, but I have a lot of friends that are into that, and what they're with the stock market, what they're all kind of trumpeting the same thing is that the dollar is about to collapse.
right,
Like
yeah, you're
United
hearing
States is
that.
slowly moving away from the dollar.
You're hearing that, but again, I'm not in that area, so I don't know what people really are doing. I could tell you, I did play around with crypto a little bit. I think I put about 5,000 in just to put some money in there,
Hmm.
and it's not 5,000 right now. It's quite a bit less.
Oh, nice. Or
Yeah.
yeah,
No,
whatever.
not nice.
But yeah, no, yeah, like I
Yeah,
mess with crypto a little bit, but I get into it, then I'm just like I don't want to watch this every day. Like I know you have
yeah,
to have the diamond hands thing, and
yeah.
I was trying to play the game where you go up and up and up and then sell it off, and I
Right.
did okay. I mean, okay meaning like a couple $100, but
I did
it's
that during GameStop when that whole GameStop explosion happened with GameStop and AMC and
Oh,
everything.
that was fun. Yeah.
Oh man, that was so wild.
Yeah, it was fun, and then they had the Reddit thread where they would tell you when to dump and
Yeah,
when to pick it
yeah.
up, and like that was awesome. I haven't seen anything like that again
No.
since.
Yeah, that was good times.
All right, so Mortgage Bankers Association is expecting rates to stick around roughly like 6.4 in 2026. You think that's kind of like the average of where they're going to stick around, or do you see them hovering more around those like high fives?
Like based on what I'm hearing, I think we'll probably be the first stat that you had up there, the 5.9 range. I think we'll be somewhere in that 5.875 to about six and a quarter. I think we'll be in that specific range. And then
Hmm.
again, that's just me guessing, but because there are so many different predictions from all these different organizations. But I think we'll be in that range, somewhere in there. I I would hope we would get a little bit lower than that, but without something major happening, I don't think we're going to see anything in the low fives, low to mid
So
fives.
so the things fueling this, because it's always going to be unemployment. What's the other one?
Inflation, jobs
Inflation,
report.
and those
Oh, you
have
said
been staying
unemployment.
pretty steady, right?
Right now it is, but without getting too far into detail, depending on the analyst you watch, some analysts believe rates should be lower already because a lot of times when the BLS puts out the labor reports, they're overinflating the numbers, and then a month later they I forget what they call it, but they redo the numbers, but it's on the back page of a newspaper somewhere, and it doesn't get the same headlines. I think
Hmm.
last year they overinflated the number by over a million jobs. I think that's what it was. I could be wrong, but it was a huge number. And if those numbers were to come out correctly, history tells us that that should push rates down. But that hasn't been the case for quite a while now, where the numbers come out and maybe they just don't have all the data at the time when the numbers come out. But
Yeah.
I think the last 2 months, we are starting to see those numbers get a little more, try to get a little closer to being accurate.
Yeah, and I mean, I've been watching since like the mid 2000s, like unemployment reports and
Yeah.
inflation reports, and it's always it seems like every couple of years they have this like, oh well, it's not accurate, or we're missing this data, and we've been missing this data, but reporting around it.
Yep.
And I know we just had that like a few months ago, where like we're gonna stop reporting this part of it. So it's, I mean, take that with a grain of salt, but I mean, there has to be some truth to the overlying numbers, right? Because when you're looking at what are we, 350 million people,
Yep. In
a little deviation isn't going to go very far, but a little deviation for a long time is going to add up, right?
and it does. Yeah,
Yeah.
it does. So I mean, when you take those things into account, you would hope that they would get the numbers right because we probably should be lower, but nobody knows how that's actually going to play out.
Yeah, and it's, I don't know, it's like they change the way they do the data every couple years. I
Yep.
don't want to go too far into this, but a couple like what, 2 years ago, like when the economy really started shifting and rates started going up, and they were doing this whole soft landing thing other than letting it crash. I
Yep.
haven't heard anybody talk about that in over a year now.
No, and all you heard back then was soft landing, soft landing. That,
Hmm.
that that's all they were talking about. You
Yeah,
know.
and it's I don't know if it worked or if it didn't work.
Yeah.
We haven't crashed yet.
Nope, we haven't crashed. And
Yeah.
and I mean, you know, I I don't think. I mean, and again, these are my opinions. I
Hmm.
don't think we're going to see a major crash. I do think, based on other economic data that's out there, there are a lot of people that are struggling. I mean, when you just look at the numbers, I think it's over $1 trillion in consumer debt, car payments, credit cards. I was listening to a podcast. I'm actually listening to a book right now. Back in 2016, the credit card debt was about 93 million. No, I'm sorry, 93 billion. I'm sorry, 93 billion. I think we're over $1 trillion now in credit card debt,
Oof.
which that's 9 years, a 9 year difference from 93 billion to
Yeah.
over 1 trillion in debt. Like that's
Well,
huge.
Well, pre-COVID, I think average was about like between 15 and 25,000. I didn't look up the stats before this, but I think I always remember hearing it was between about 15 and 25,000 per household. The latest stat I've heard, it was between about 50 and 60 per household.
You're correct. I've even seen it as high as 80 grand, like 80,000, like depending on where you're getting the information from.
Mhm.
About 80,000 of credit card debt or consumer debt.
Yeah, it seems like when I talk to a lot of people like in the financial space, like yourself or other lenders, they kind of brace themselves for about like 70 to 80 just
Yep.
on average.
Yep.
So I'm sure you guys see something. You guys are dealing with a lot more of that, but so I'm sure the news gets a lot slower, or people actually like playing in the market are going to have a much higher debt
Yeah.
cap.
It's a big number, and I think that's more where a lot of the challenges are for people right now is the consumer debt.
Yeah, and one thing I thought would really knock the economy back down or course correct was either going to be student loans, credit card debts, or auto loans. It seems like the money markets are finding a way to finagle around that. Like you have what 7 8 year car loans now, where prior to COVID it was 5 6 years.
So they're working around it, but there is a lot. There are the number for car delinquencies is consistently going up every month. So that number is getting higher and higher. The number of repossessions is getting higher on cars, and it's part of it is from some of the stats I'm seeing. A lot of people that bought cars. Let's just go back 2021. You're talking 4 or 5 years ago, right? A lot of times
Mhm.
people will keep their car 4 or 5 years. A lot of the cars that were purchased at that time, if you remember, cars were super expensive, and a lot of these cars now, 4 or 5 years later, they're still 30, $40,000 upside down, and so you can't do anything with it. You either pay it or you give it back. And I think that's a big part of the market right now that we're seeing, um, that's I don't want to say crashing, but that there's a lot of negativity in that market right now. And
Yeah, and I guess now thinking about it and kind of hearing that, like that part of the market is, when it's 30,000 per person, let's just say a car or a credit card that they're going to default on or bankrupt over.
right,
That's a way smaller impact on the overall economy rather than, like a finance sector or housing or loan defaults or what have you. So
right.
the correction's not going to be, I mean, on the overall ripple effect of the economy in the country, it's not going to be nearly as drastic.
Right, right. I mean, the thing about cars and credit cards is when you own a home or you're paying rent or whatever it may be, you're gonna want like your biggest expense is shelter, your housing expense, right? You're
Mhm.
gonna want to make sure that nothing happens to that, whether you own a home or rent a home. So you're gonna do everything in most cases to try to pay that before you actually um, if it's a toss up between your car and your house, 99% of the people are going to pay for the house and go late on the car and try to figure something else out. And I think that's been happening for a few years because if you go back to the COVID years, 20 and 21, savings was at an all-time high. And that was, if you remember, there was a lot of stimulus checks and that stuff going out.
Oh yeah,
So
yeah, it was wild.
people
Everybody had
had
cash.
pe- yeah, people had more money in savings at that point than in any other time. Fast forward to today, everything is flip flop now. There's less savings and more debt. So it was at that time it was more savings, and now it's less savings or no savings and a lot more debt. So
Yeah, totally agree. I mean, I've completely seen that too. It's during COVID, it's like everybody had cash. Like
yep,
somehow they just
everybody
had
did.
a ton of cash to go out and do these crazy things on cars, homes, what have you.
Yep.
But yeah, and I see these stats on debt, like credit card debt, student loans, defaults. It's like, oh, okay. But one thing I'm not seeing go crazy though is default on homes or foreclosures or pre-foreclosures. Seems like
Right,
that's
we're not
still,
seeing that.
yeah,
Right,
yeah. It
we're
seems
not
like
seeing that
housing's
anymore.
still like just trucking along, which
Yeah,
it's wild. But I guess if you get out there and you look and you think like, okay, I can you know foreclose or short sell on this house and just go buy again. You're buying in today's market.
right.
Today's market is very similar to probably the market you bought in 3 years ago. and
Right.
there's no evidence or signal of a correction coming.
No. And that's where I think the media gets it wrong. So many people talk about a crash, but you're right. There's no evidence, anything to suggest that a crash is coming. Even with all of those other things happening with the cars and the credit card debt, housing is, like you said, is still trucking along, and it's still, even at a 1 to 3% increase in appreciation, that's still a healthy housing market.
Mhm. Yeah, because like 1% appreciation on $600,000 house, you almost have your down payment back if you buy at a 3.5% rate within about two and a
Right.
half years.
Right.
You
Right.
know, never mind what you already put into the house. You already have that forced appreciation, so
Right.
you're still making money on that initial investment.
Yeah, and housing was never meant to be, you buy a house and it goes up 100,000 in 2 years. It was never meant to do that.
No.
The other, besides COVID, the COVID time, the only time I saw that was back in 2004 to 2006. At that time there was a lot of new construction here in the Inland Empire, and people were putting deposits on their homes before they moved into the home. The house had 50 or $60,000 of equity already, while
Yeah.
they waited for it to be built, and even more. So, and people thought that was going to last forever, and obviously it didn't.
Yeah,
Those
and
are
that
the
was, I
numbers.
mean, it was a pretty similar, I don't want to say it was a similar market to COVID because restrictions were way more loose back then,
Right.
but it was similar. Like during COVID, 2019, 2020, 2021, people were putting deposits down on homes, and, we had delays in manufacturing,
Right.
logistics, what have you. So that 6 month build out was taking closer to 18 months, 2 years, 2.5 years. So they were buying a $300,000 house, then moving into a $415,000 house,
Yeah.
selling it, and then leaving the state or going and buying something else.
Yeah. Those times don't come around too often.
No,
When
no, and it's
when you see that much of
yeah, and
appreciation.
it's absolutely it's a blip on the radar. It's
Yeah.
if you're
Yeah.
trying to time it, you're gonna miss it.
Yeah. And
Because once you see it might be good, you're gonna be like, oh, it's gonna get better,
right. You,
and
you
it's
fall
gone.
into those. You fall into that by accident, not by
Mhm.
timing it.
Yeah, and I mean everybody I know that's had something like that happen where they caught it at the quote unquote right time, 100% accident. They were ready at
Yeah.
the right time,
Yep. That's what it is for
and
sure.
everybody was warning them against it too.
Yeah. Yeah.
Okay, so California and Inland Empire trends. Median home prices rose about 3.6%. As I mentioned earlier, things went up about 4 or 5% depending on the area until about June, July of this year. Things have kind of come down slowly, about 2 to 3%. So for Riverside County, we're up about 2% on the year. So about 3% statewide is right on brand. Single family homes rose about 2% versus 2025. Active listings forecast, they're projecting, stats are projecting things to increase as far as active listings by about 10%. I can
Yeah.
say with the conversations I've been having with past clients, folks reaching out off this channel, my other socials, open houses, what have you, I definitely see an increase in active listings coming up. I don't think it's going to be a wave that's going to drop pricing, by that much. I'm also having a lot of conversations with a lot of buyers that are ready to finally get in the market.
Yep. Yeah. That's. I'll go
Yeah.
ahead.
Oh, no, I was going to say, go ahead.
I think those are good stats, man. I'll tell you the staggering stat to me is median home price 905,000. Across California. That's just like insane.
It sounds insane, right? Like, that's crazy.
Yeah, it just sounds nuts, man.
Yeah, and disclaimer, where we're at, Riverside, Moreno Valley,
Yeah,
Inland Empire, average
yeah,
price is closer to about 600. Moreno
yeah,
Valley, you're about 560. You go south of Paris, it's about about 550. Riverside's about 650 right now. So if you're looking for affordable housing,
The Inland
watch more of my
Empire
videos.
the Inland Empire has for a number of years been that affordable housing spot to go to. And
Yeah, and that's why we've been
great.
pretty insulated. We haven't seen any really much of a correction at all in Inland Empire. Like even during that 2022 time, it was maybe a 5% correction across like the IE, which is about 50 something cities. If you go out to OCLA, they were closer to about 10 to 12% correction during that time.
Right, right. Yeah, which is interesting.
Yeah. So as I was saying, IE focus average prices, yeah, about 580, kind of what I just said.
Yeah,
Um, one thing I keep seeing is 2026 is supposed to be more of a transitional period rather than a crash or a boom.
right. And I think you mentioned like some of the stats I saw was about 1 to 4%, in home prices.
As far as
Every
gain.
Yeah, as far as gain, that's what I've seen. Again,
Hmm.
time will tell, but I think 4% about has been the average, for a long, long time. So 10 or 12 or 8% is not normal. So if you get a 4% gain, that's pretty healthy. Or again,
Yeah.
it's not good. It's not good for buyers like we talked about, but it's healthy for somebody that owns a home.
Yeah, and when you see it more consistent, like it's been the last couple of years, like that, like 3%, 4%, it is way easier to plan, manage, and set your expectations. So if you're starting out or you're on your first home and it's not your forever home, when you're looking at something that you're buying for 500,000 and you're thinking, 5 years I'll be out of here, move on to the next one. 5 years at 5% at
Right,
$500,000, you're going to be selling about a $530,000 house.
right, right.
So
You
when you're
can,
looking at those $600,000 houses, your expectations can stay in line a lot better than like when you go through something like COVID or like 05, 06, or I would say even like 11 to 14, 2011 to
yeah.
2014, prices popped up like crazy.
Well, at the end of 10, beginning of 11 was the bottom of that market, and then from 11 to 14, yeah, you saw a lot of prices go up during that time pretty significantly.
Yeah, and it was a smaller price point,
Yeah,
but I mean they popped up. Like $90,000 houses were selling for 200,000.
yeah, we saw a lot of if you remember, there was a lot of cash buyers back at that time too. A lot of investors were buying, and the market was just becoming healthy again. We had just had the 5 6 years prior where the market had crashed,
Mm.
so people were ready to start buying houses again.
Yeah, and people were scared too. It's I bought my first house during that time, and I mean, everybody was warning me against it. And I was just like, yeah, there's no way it could go any lower back then. Uh, I wasn't in real estate at the time, but I was a huge student of the market. I was in
Yeah.
college in '07, '08, so I was trying
Okay.
to figure out where I wanted to live when I got my degree.
Yeah.
I did not account for there being no jobs to go buy a house back then, but
Yeah. Who knew that, right?
no, no, here we are, and I'm okay with the way things turned out.
Yeah, for sure.
So Inland Empire is coming off a small price correction. It's forecast to shift from flat to gently rising prices in '06, as we mentioned. I see IE Inland Empire probably going up about 3 to 4%. If you look at the nationwide and state projections, like John was saying, probably about a percent and a half. Inland Empire usually it's pretty close, but it outpaces from what I've seen. So I see inventory rising, but I also do see a lot of buyers coming out of the woodwork. Another thing I think affecting that and enticing buyers to come out of the woodwork is new construction homes. There are new construction plans, communities, developments going on
Yeah.
all over Inland Empire. I think Moreno Valley, that's my city. We have about four going right now. Riverside, that's another area I cover at length, has about six going right now. Paris, a little bit smaller city, has about five going right now as well. San Jacinto is the bigger one that's up and coming, and it seems like there's a new one popping up every 2 months.
Yeah, yeah. But which I mean, it's good because we need the housing. I think our affordability issues are tied more to needing more housing than rates. I mean, it's a combination, right? But when you don't have enough homes, I think that's where a big challenge is for on the affordability
Mm.
challenge. Is that
Yeah,
that
and I mean to really go back, 08, '09, there was a lot of new development coming in.
yep.
When things crashed, a lot of those, I mean, almost, I'd say
They
almost all those
bailed.
builders out here were done.
Yep.
Like
They were
I
done.
remember looking at new home, or I remember looking at homes in 2011. That's when I started looking for my first one, and there was full communities, full developments that were half, like literally half built,
Right, right.
and they just done. Like it was like the circus just left, and that's what was there. I mean, eventually somebody came in and bought most of them up or bulldozed them, but a lot of builders were scared to take take on that task again for the next, I mean, really 10 years. Like there was
Yep.
developments going on, but on the realtor side, a strategy of ours to go sell homes was never new builds until probably 3 4 years ago.
Right. Right.
So that 10 years, 13 years that it took them to really get comfortable selling and comfortable that this was going to be an ongoing market. We were criminally underbuilt during that time.
Yeah. I
Which led, yeah.
No, go ahead. Go ahead.
Oh, what I was gonna say is that led to a lot of the housing shortage, and being in the
Yeah.
business, I think around 18 19, I started to realize like the real crisis right even then was there's not enough homes.
Yeah.
Because we were in a seller's market for, I mean, we're still in one, right? It started in what, probably like 11 12.
Yeah. Yeah. It hasn't really stopped. I mean, we've had dips along the way, but it hasn't really stopped.
Yeah, yeah,
It-
not dips that mattered, and I mean historically there's only been a few dips that actually mattered, but
yeah.
you have more adults are living longer.
Yep.
You have more people coming into adult age. I think the stat still is average first time home buyer right now is like 40 or 41 years old.
Yeah. And just a few years ago, it was 30, 31, 32 years old. And we're talking literally a few years ago. From that point to now, it's jumped up to 40, 41 years old. It's just taking longer for people to be able to get into that home.
Yeah, which is wild. I mean, because like forever it was you. I mean, the old thought was you go to college, be a young
Get
man,
a
young woman,
job.
whatever, get married, and then you go shop for that house. I mean, historically, it'd be like late 20s, early 30s,
Yeah. Yeah.
right? So now it's a lot of those folks are living with parents,
Yep.
renting
Saving
until
up
40,
money.
41, which is wild. Um, one of the things I see or one of my thoughts with this is wages are finally starting to come up. Housing's starting to flatten a little bit. So I think we're finally at a point where wages are going to come up faster than the cost of living.
Yeah,
I could
they
I
are
could be dead
coming
wrong with
up.
that, but I think that's kind of what we're going to see the next few years before we really see a correction.
I, I, I will tell you, there are certain sectors out there that are making really good money as far as wages go.
Mm.
I mean, and some just haven't caught up, right? So you may be onto something there, because I am seeing more of the 20 somethings and early 30s somethings employed in some really good, high paying jobs. And when I say high paying, I'm talking like, 180 to 220 a year for a 28-year-old guy who's in a specific type of job, right? So we are seeing more of that specialized stuff. I'm talking about like engineering, certain type of engineering, certain type of like I have a client right now. He's some sort of computer analyst within a company within a large LA County company. So I mean there's more and more of it, but still not. People still aren't making that on an everyday basis.
No, no, they're not. I mean, average income for Moreno Valley. I did a video on it. It was like 92,000.
Yeah, similar numbers.
Riverside City was about 115,000.
Yep.
I want to say San Jacinto. I do a lot of video on this stuff, so I
Yeah.
spent a lot of time researching. San Jacinto was about 82,000. That's per household. That's not per individual.
Yeah.
But with that, things change, right? Like the younger generation comes in and they see, hey, this isn't working for my mom and dad. I'm going to try something different, right?
Right.
So
Right.
they see, school teacher, you start at what, like 70 grand a year. You can't buy a house
Um,
on that now, or it's very tough, or you have to have a partner. So that I think the younger generation they'll figure it out before we do, and that's just kind of the way it's always been, right?
just quicker. They're quicker at it.
They're quicker, yeah.
Yeah,
They don't
figuring
have
it out.
like we're setting our way, or we, but we're setting our way. So like you're told certain things, you go work your butt off in a certain way. Like
Right.
for me, it was don't go to a trade school, go to college.
Right.
Went to college. We came out of college, like I was saying earlier, there was no jobs for my major, so I kind of bounced around, and then luckily I found real estate. Happy I did. But if things were like say I graduated a couple years earlier because I graduated high school in '03, say I graduated a couple years later, there's no way I would have gone to college.
Right,
It
right,
was
right.
it was devaluing as I was going through it, and I was already in it, so I didn't realize it.
Yeah, yeah. Things change. I mean, different generations, things change, right? So
Hmm.
I think you're spot on when you say that the younger generation is figuring things out at a much faster pace,
Yeah.
they're just jumping in and getting into certain things.
Yeah, and like with like AI, and not saying that you can use AI to go. You probably can go use AI to go find a $500,000 a year job. These kids are using it more than we do, or the younger generation.
Yeah,
So they're going to be a lot more proficient at it. So they're going to be able to, theoretically, they should be able to identify those jobs around that sector where that's
right,
where the need is.
right, and they're doing it. They're doing a good job at it. You
Mm.
know, so some people it just takes a little longer, but nothing you can do about it. Just got to work.
Yeah, it's just work. Yeah, we're working through it.
Yeah,
That's the point of life, right?
yeah,
But cool. Yeah, that was all my slides. Do you have anything you want to add on that? I feel like we covered quite a bit, but
yeah.
so
We
I know
covered
usually
quite
when
a
you and I
bit.
do these, we go about an hour and a half.
I I do think I do think we're going into some better times. I think we've been in this 3 year bubble, so to speak, where it's been very volatile, like you said earlier. I do think we're going to be going into a some better times. Um, I think although prices aren't going to drop, lower rates are going to make it a little more affordable for people. There are different options that they can use to get into homes. Um, and I think it's going to be helpful for more people. And like we talked about earlier, I do think if we do get to that certain 5 point something range, we don't, there's going to be a number there that it's going to click where more of your sellers are going to want to sell and move. So we just gotta. I agree that it was that 5.5 range, but who knows? Somebody who's been stuck in their house for 3 or 4 or 5 years and hasn't made a move, they might be okay at 5.8 or 6%.
Yeah.
It's time. It's like we can't wait much longer. But
No, no. I mean, a lot of people have shot themselves in the foot by waiting. And the other thing I see too is, people that did not buy during that time or weren't even looking during that time. The conversation. Oh, where are rates at? 6. Oh, okay, yeah, they were at 6.5 last year when I was looking.
yeah, yeah, and we're actually doing, like, just to put it in perspective. I have a client right now that's buying in Victorville. They're self-employed, so the taxes don't fully show all of their income. They make the income, but it doesn't show it. But based on
Mhm.
the taxes, they didn't qualify for an FHA rate at like 5.5. So they're doing a 3 year ARM on FHA, which is a very safe ARM, and the rate's 4%. So in these 3 years of these upcoming 3 years, they're going to be able to get the taxes in line, more in line with their show more income, so that they can just refinance out of that in 3 years or whatever they have to do. So there's option. My point is there's options for people, right? And on that one, the seller in Victorville is paying for that buy down.
Oh, nice.
So yeah, so it worked out perfect for these buyers because this is the house they wanted, and that's what was negotiated. So my point is, you can still get into homes with a little bit better payment by just restructuring or doing something different and just being open to the conversation. As a lender, and just like you, I'm sure, as a realtor, we just provide information. We provide information, we educate people. Ultimately, they make the decision as to what they're going to do.
Yeah, literally, we're just. I mean, at the end of the day, we're just advisors.
Yeah, that's what we are. And as long as we're doing our job, it will help people down the road get into homes. And
Yeah,
and
yeah.
I I think it's alleviating the fear as well. There's still a lot of fear out there, and
Mhm.
it's just alleviating some of that fear to help people get in. But I do think that based on projections, like I'm looking at this, I think there was about 4.1 million resale homes that were sold this year. They're projecting about 4.8 to 4.9 million resale homes next year. Okay, now you're talking an additional, 800,000. I think. Let me see.
Yeah, that's about
Um,
where I've been hearing too. It was, I think this year it dipped under 4 million. Usually it's about 4 to 5 million. I think COVID
yeah,
was like 6 or something wild.
COVID was crazy because we
Yeah,
did over 4 trillion in loan volume during COVID when the normal is about 2 trillion.
yeah,
So yeah, that was just nuts. But yeah, I mean, there's there's going to be more opportunities for people. I really believe that going forward. You know, in,
yeah. I do
even
too. And that, like I was saying before, like with the advisor thing, like literally, our job is to find solutions,
right,
right? Find the right loan program, to find the right neighborhood, the right area, the right situation. And I think people are warming up to that again because I think there was like this misconception that your first house had to be this big freaking badass, dream home. And I think people are getting more realistic with, okay, your first home's not going to be your forever one.
yeah, and like I have some clients right now that they bought a number of years ago. Their first home, they bought in Hemet, I think probably about 2017, 16 or 17. They got the home like in the 100s, like 170, 190, something like that. And since there's a two-bedroom, two-bath home, since then they've had two kids. And they're looking at it from their perspective is we have plenty of space. They're working on adding on to the home right now, adding another two bedrooms and another bathroom.
Mm-hmm.
So, and they have the space for it. That's an option for people as well. Because, but you're right. You don't step up to your dream home on day one.
Mm-hmm.
It's a progression. For most people.
Yeah. Yeah, and I'm seeing a lot of people do that too, where it's like that, they have the 2 bedroom, one bath, or, then they have a couple kids or life changes or,
Right.
in-law moving with them. And they start looking at those solutions for like the HELOC or the ADU or adding on to it. And, sometimes it makes sense. Other times it just makes more sense to, move on to something else.
Right. Absolutely. I agree. And it's just, but by having a home, getting into that first home, at least it gives you options, right?
Hmm.
Because that home that these people bought for 180 or 190 is now worth close to 500, or 480 or something like that.
Yeah.
It's up there, so they have tons of equity. So they have
Yeah. And
options.
the way I've always, thought of it is that you're like when you go to the beach, you're jumping into a wave. You're gonna have more
Yeah.
fun jumping in at the bottom, but if you jump in at the middle, you're still gonna get to the top eventually.
Eventually,
Yeah.
absolutely, man. So, yeah, I think my opinion has always been never to hard sell anybody on buying a house. Just educate them, advise them. But at the end of the day, if you can afford to get into a house, if you take rate and payment and everything else out of it, but when you look at your numbers, if it makes sense and you can get into the home, you should do it. Not because of me, but because history shows us that home is going to continue to increase in value and you're going to have your own space.
Oh,
No
absolutely.
matter what.
Even when it goes backwards, it goes forward at some point.
Right. It always does.
Yeah.
So yeah, I think that's good stuff, man.
Yeah. Okay. So to wrap up, 2026 projection seems like the market's going to stay steady. Probably more options for buyers. Something I did notice this year is inventory was down, days on market were up. So initially, when I was taking folks to look at homes, it felt like there was more options. After a couple of weeks, what we realized was there was more options, but they were the exact same options, which I've never really dealt with in the 10 years I've been doing this, and it's kind of weird to think about. Days on market did go up a lot, but it's people a little more gun shy. Things are more expensive, and home sat longer, so you didn't have to jump on it like you did a couple of years ago, where if you weren't on it in a weekend, it was gone. 2026, I do see days on market possibly coming down with rising inventory, though that could change. But a lot of conversations I'm having with people right now are people that are ready to buy for the first time because they're tired of waiting.
Yeah.
So I don't see a huge course correction. I see a pretty balanced and healthy market, although I do see it still staying a seller's market. But that's kind of my take on it. John, you want to throw your 2 cents on? Two
I
cents
think you're
in?
right, and it's funny because when you throw out the term buyer's market, I think a lot of people, depending where you are, it could be a buyer's market in some specific areas and a seller's market in other areas. But I do think in our area, it's still going to be more of a seller's market. I think sellers are still going to budge a little bit when it comes to helping out buyers, and
Mhm.
I think they're buyers. Buyers are more picky right now from what we're seeing because of the additional inventory. But I think there's that healthy point where the buyer wins and the seller wins, and I think that's going to continue going forward.
Yeah, no, I like that. It's a, real estate transaction. It's, I know some people look at it as like, oh, I have to win. I have to negotiate this. I have to,
Yeah,
take this or, the house is listed at this. I got it for this much under.
right,
Really what a transaction is, seller wants to sell or they have to sell. Buyer wants to buy.
right.
When you get into transaction, it's that house. You're going to land somewhere in the middle.
Yeah,
That's a healthy market. That's a healthy transaction. When you get into a situation like like COVID, where buyers are coming in and they're draining their 401k, going
yeah,
100 grand, 40 grand over asking. That they're excited to get the house because they won, but then there's hurt feelings on the other side.
yeah,
When you go to like a 2008 where sellers are like losing their butts, and buyers are just they're kind of chasing the market down. Sellers are doing the same thing. They're losing their house. They just erased a ton of equity. There's hurt feelings on the other side. I think with these balanced markets, it's more of a friendly everybody wins type transaction. So it's you feel better about the purchase. You feel better about the sell.
absolutely. And I think that's what it's about is just walking away feeling good about what you just did on both
Hmm.
sides.
Yeah, and
And
that's good business, right? There's no better
yeah,
business than everybody wins. There's no hurt feelings at the
right.
end. Of course, in the middle of the transaction, things do come up. But when it's we'll say like a $5,000 roof issue, that's way better than a $20,000 erasing of the market,
Right, right.
or $15,000 that you had to borrow from somebody to cover an appraisal gap.
Right.
You know,
Or sitting on the house for 6 more months making mortgage payments. But I mean, like, because now you can move on with your life.
yeah,
So there's a lot of things on both sides, the buyers and the sellers, that can make the transaction a lot smoother.
yeah, yeah. So I mean, with that said, I see a very healthy, balanced market. Kind of similar to what we saw in 2025. I just see better feelings about it going forward.
And I think that's true. I think the sentiment is that it is going to be better, and I look forward to that. Just a little bit healthier market because the more healthy we get in the market, just the better overall it is.
Yeah,
For
absolutely.
for everybody.
It's a lot better, when buyers are actually out looking and you can give them a solid game plan. It's not changing, week to week or quarterly to
Right.
quarterly. I mean, there's always going to be those nuances and those little things that shift and change here and there. But being able to put together a realistic game plan like in January and execute it in September,
Yeah.
and not being like, oh, you missed it.
Yeah. Right.
That's a really good feeling, and that's really 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 inspiring and posy. And yeah, now that I say that out loud, I'm really looking forward to that actually.
Yeah. See, it's looking better already.
Yeah. Yeah, so yeah. If you're looking for doom and gloom, I'm sorry, I probably screwed that one up.
No, I don't think it's doom and gloom, man. I think it's good stuff.
Yeah,
You know.
so cool. Well, I guess that's a good place to end it. John, thank you again for hopping on, man. You always
Yeah.
make these a lot easier on me.
I
I
appreciate
think
it.
we're kind of similar mind, and your experience definitely goes a long way. And I really do appreciate you offering your insight on these things.
Yeah, I appreciate you having me, man. This is always fun. We get to just go back and forth on what's happening in the market, and I love it. I think it's cool.
Oh yeah, I enjoy doing these. I mean, even if I
Yeah.
don't get views, I just like doing them. This is cool. Get to kind of exercise that real estate muscle a little bit, and
Yeah.
kind of work out like what's going on in the market out loud, and it gives you a different sort of insight into it rather than just reading whatever online from Car and R or whatever they offer, or hearing like the broker report.
Right. And I love we're both in the industry, so when you actually study the stats and look at the stats, you're just more equipped to better educate people down the road anyway.
Yeah, absolutely, and like I'm in it every day. Like this is what I
Yeah.
do. I just freaking talk about real estate all the
Yeah.
time.
That's it.
But cool. Yeah, that's a good place to end. So, John, again, thank you for hopping on. If you're here with us towards the end, thank you so much for watching. Don't forget to subscribe because I post these weekly. I also have my Thursday videos where I do more of an in-depth tour into an area or a new construction community or pricing, what have you. Anything you want to see covered in the future, comment below, shoot me a message. My contact information is somewhere down there. I'll throw John's in there too if you have questions on the loan, mortgage, what have you side, appraisal, HELOC, refi. He can absolutely get you squared away all day long. Again, thank you guys so much for watching. We'll catch you on the next one.
Sounds good.